Welcome to Strictly Money at the News Forum. I'm your host, Saijal Patel. Taxes. In Canada, we definitely pay our fair share of it and then some. Taxes also create a huge drag on our ability to build wealth and a retirement nest egg more effectively. So if you've wondered how to make better use of investment tax schemes like RSPs and tax-free savings accounts, you're in luck. Evelyn Jacks is a tax specialist and the president and CEO at the Knowledge Bureau, and she's here to tell us how. Evelyn, it's so great to have you on the show.
Well, thank you so much for having me. So great to be here too.
You know, understanding how to navigate taxes feels so complicated. And so a lot of people avoid it. And yet we know that it's an important part of financial planning, isn't it?
Well, it is. It is one of those wealth eroders that we actually can do something about. We can't do much about inflation and we can't do much about, the fluctuations in the marketplace, but we actually can, and it is our right to arrange our affairs within the framework of the law to pay the least amount of tax legally possible. So you have to pay the correct amount of tax. You have to file a tax return, but it is our right to take steps to mitigate our tax.
Well, okay, so let's get into it. RSPs. Now, this is an investment scheme. It allows you to take a tax deduction up front. The investments grow tax-free until a much later date. So it's basically tax deferred. Evelyn, there's a growing belief, because I see this all the time on comments, that RSPs are not great vehicles because they have to pay taxes later on, and that TFSAs or non-registered accounts are the better route. Do you think that's a valid argument for most Canadians?
Personally, I don't, because I'm a strong believer in the time value of money. And that is that a dollar invested today with the potential to make earnings for tomorrow is a much stronger dollar. So, for example, if you pay taxes today and you pay taxes needlessly, you're not going to get that dollar back. But if you put your dollar today into an RSP, first of all, you're going to have tax savings. And for some people, those tax savings are 30, 40, 53% on a dollar that's earned. You have to understand your marginal tax bracket. So let's say you're paying a 40% marginal tax rate. Every $1,000 you're going to put into an RSP is going to save you $400. And with that $400, you can stuff that money right into a TFSA. So your RSP can actually fund your TFSA or non-registered savings. So that's point one. Point two, people forget that there are tax credits that are based on net income. And your RSP will reduce your net income. So that means you're going to get more from things like your Canada Child benefit or even your old age security benefits if you're in what's known as a clawback range. And thirdly, while your money is in the plan, it's tax deferred. So that time value of money in the plan is working for you. Now, granted, yes, when you retire later on, both the principal and the earnings are going to be taxed. But there's lots of tax strategies to average in that income over time to pay the least amount of tax as possible and to do some income splitting.
Yeah, we'll definitely get into that. I wanted to turn to TFSAs. A lot of people like them. I personally like them because it offers more flexibility. From what you have seen, are there occasions where people are not probably using it as effectively as they could?
Yes, one of the first things to say is I believe the last statistics that I've seen is that 2/3 of Canadians are putting their money away into a TFSA. They're not maximizing the $6,000 we can put in now. And it's really important that you do because, of course, you are funding this with after-tax dollars, but when the money comes out later, then, of course, there's no tax on either the principal or the earnings. Another real bonus of the TFSA is that you never lose your contribution room. So even if you use it for an emergency, you use it to buy a home or to fund an education, you can put the money back. However, there are some time limits for putting the money back.
Right. Okay, so we're going to take a quick break and we're going to continue this conversation because I want to get your thoughts on using the RSP plan to buy a home. Welcome back. I'm here with Evelyn Jacks. Evelyn, before the commercial break, we were talking about RSPs and TFSAs. What are your thoughts on using RSPs for first-time homebuyers?
So it's a great opportunity for people who don't have enough money saved up because you can actually take advantage of pulling money out of the RSP, funding that purchase of your home, and then putting the money back over a defined schedule without paying any extra tax on that. My issue with that is that I think it is sometimes done at the expense of your retirement savings. And so, again, this concept of keeping the pots of money separate, if you have any other alternatives, you can borrow from mom and dad. Perhaps you can generate some funding on a tax-efficient manner from your non-registered accounts. Those are some of the other things that you could do. But certainly the advantage is that you can pull out $35,000 per individual, so $70,000 for a couple under the RSP Home Buyers Plan. And that will give you a tax advantage immediately because you don't have to pay tax on that withdrawal.
I think you raise a very important point because I've always wondered, why do we mess with a retirement account when saving for retirement is sometimes so difficult? And, I'm wondering if we're incentivizing people to spend near term and not think about the long-term future. Evelyn, I want to get your thoughts also on what the Liberals are planning. They're looking at least at a new tax-free first home savings account. What do you think about that?
Mm-hmm. Well, the advantage of that proposal, and of course it's not law yet, we'll have to wait for legislation to come through and royal assent. But the opportunity here is for people under the age of 40 to save up to $40,000 in this plan. Now, it is going to use up your RSP contribution room. So again, we're combining the opportunity to save for a tax-deferred retirement with the immediate need to pull money out of kind of current savings for a home. So the opportunity is the money goes in on a tax-free basis because you get a deduction. It comes out on a tax-free basis later, so that's a benefit. And you have to use up to 50% of the money for the purchase of the home. On the downside, you are compromising your ability to save on a tax-assisted basis within an RSP, and it's complex. I think the way that this plan is structured could be easier, and I'm not sure that people are going to really understand the consequences. So those are my pluses and minuses.
Evelyn, for someone who looks at this a lot, watches tax policies, advises, from what you see, what would be an ideal sort of tax scheme? I know I'm putting you on the spot, but I'm sure you have some ideas of what we need now, whether we can borrow from other countries and what's worked, and maybe whether we have to think about updating it with the times, because challenges are different these days than they were even 10, 20 years ago.
I think it's a very good question. We've been using as our foundation a tax system that was introduced in 1972. It introduced capital gains taxes, for example, and a host of other provisions. And it's been a good tax system. It's one based on self-assessment, and we have a high compliance rate. However, it's harder to comply as things become more complex. And of course, the tax system is used in so many different ways, aside from collecting taxes. We're distributing benefits, and we're trying to tweak economic and social needs. However, that's always at the cost of complexity. So back in the day, we actually had a registered homeownership savings plan. And that plan was very simple. You could put $1,000 a year away per individual, and over time, young people could buy a home. So maybe $1,000 isn't the right number anymore, but the beauty of that plan, and it was a Made in Canada plan, was that it separated out retirement savings from ownership savings. And certainly that would be something that I think that we should look into. Again, it's ancient tax, but sometimes ancient tax can teach us a lesson and show us the way forward.
And when did they get rid of that?
I think they got rid of that. It seems to me back in 1987. I could be wrong about that. So it's been around. It was around for quite some time in the 70s and 80s, as I recall it. I hate to admit that I was around back in the day. So that's aging me too.
Oh, interesting. Okay, well, we're going to take a quick break. And when we come back, I'm going to get your thoughts on tax strategies in retirement. Welcome back to Strictly Money. I'm here with Evelyn Jacks. Evelyn, I want to turn and talk about tax strategies in retirement. Very important, especially because this is the time where you're trying to reduce your taxes and save more. So going back to RSPs, can we talk a little bit about spousal RSPs? Effective ways of using it, because what it does is it does allow for income splitting.
It does. And of course, this is where things get really interesting, because your retirement period, where, first of all, hopefully you've got your money in the right pots for each person. You've got TFSAs, you've got employer-sponsored RPPs, registered pension plans, RSPs, you've got your Canada pension plan and your old age security. So and then you've got your non-registered plans. So you've got 6 buckets of money minimum that you're going to have to decide what comes out first. And there are some interesting options for income splitting. So for example, if you have money in employer-sponsored plan and RPP, you can income split up to 50% at any time. If you have money within an RSP or a RIF, you have to wait until the age of 65. And if you have money in the CPP, you've contributed to the Canada Pension Plan, you can income split at age 60, as long as you're each age 60. So the spousal opportunity is that if you have put money away into a spousal plan, then the lower income earner, assuming that's the spouse, can actually start withdrawing all of the money, over a period of time, periodically sooner than the higher income earner, who may want to wait until the age of 65 in that case, and then split income with the lower earning spouse. So the spousal opportunity is that you can equalize your pension savings, and you might have one person who at a lower income earner withdraws sooner than the person at the higher income earner who waits and then income splits.
Is there a particular order that you would advise people to start withdrawing in retirement? And I say this because the decumulation part in retirement is so hard for people to figure out. Accumulation is one thing, decumulation is a whole other thing. So what do you advise? What are some of the things that they need to think about?
Well, most people don't start early enough to think about it. And I believe that you should think about it from age 50 and forward, particularly if you have an employer-sponsored plan, because that probably will come out first. You are amongst the fortunate few who retire the earliest in Canada. Self-employed people retire the latest. And so, secondly, you would want to take a look at whether you want to continue to contribute to the CPP if you're working past the age of 65. In that case, you can opt out, and probably it's better to put your money into a TFSA at this point rather than continuing to fund the CPP. The reason being that the survivor's benefits and the death benefits are going to be better in a TFSA. So it's complicated, but it's fun. If you have the knowledge, you can actually help yourself to a much richer retirement and then survivor's benefits later.
The interesting thing, you raise CPP. What I have seen is that most people don't delay CPP. They think that they should take that early, and they push off converting RSPs to RIFs. The pros and cons to that?
So the CPP is an indexed pension, and it has been growing well. It's been well invested, and it will not fund more than probably a third of your retirement savings. So I wouldn't hang my hat on the CPP only. You definitely are going to have to supplement it. The issue with the CPP today is that the premiums are going up quite dramatically. And the people who are going to be retiring over the next several years are not going to be seeing the benefit of that. And because those premiums are roughly equal to or greater than the amount that we can put into a TFSA, the issue becomes I would rather probably be wanting to save in a tax-free account as opposed to a taxable account like the CPP. But this truly requires some help from a professional who is well versed in retirement income planning because there are so many options. And that professional really should be able to do what if scenarios for you from an after-tax point of view.
Yeah, it's not very easy to do back of the envelope calculations, is it? And I always say when you're getting closer to retirement, this is a time where you do want to think about engaging an advisor, even if it's a fee-based advisor itself.
Absolutely.
Yeah, Evelyn, we're going to take it. Pardon me?
I'm sorry. It's so empowering to have those numbers, which will tell you the story.
Yeah. We're going to take a quick break. We'll be right back. Welcome back. Our guest this show is tax specialist and CEO at the Knowledge Bureau, Evelyn Jacks. Evelyn, let's talk about entrepreneurs. Some of the ways that they can look at building their retirement nest egg in a tax efficient way, because sometimes they fall into a different category. When does it make sense for them to pay themselves so they create an RSP contribution room?
I think it's really important for entrepreneurs to do a variety of things, including generating enough salary for themselves so that they can contribute to an RSP. So 18% of net income is going to be the amount that you can contribute. And as your income rises, your net income rises from your business, you can contribute a dollar maximum in 2021 of $27,830. So $27,830. And that's based on your net income of the year before. So if you're at that level, you could have made just over $154,000 and in order to top up your RSP contribution. And that becomes very important because many business owners have sort of all their eggs in that one basket, which is their business equity. And so having funding for your retirement outside of your business is important, particularly if you're a professional. Medical practitioners, for example, don't typically have a lot of equity in their practices, and therefore they have to earn high incomes and fund their RSPs as a result of that. Now, other entrepreneurs, they may want to make the decision to take dividends out of their businesses instead in order to get a slightly better tax rate. Later on, when they retire, they can income split with their spouses at the age of 65 with those dividends. And they can do that in any amount. So it's not up to 50% of any particular earnings. They can actually income split quite generously with their spouses, even non-active spouses at the age of 65.
When they do have a corporation or they're incorporated, at least their businesses, it does give them a little bit more flexibility. The dividend income, I wanted to ask you about that because is there a point where it's too much? Does Revenue Canada kind of go, whoa, you're not paying yourself and you're taking too much of the dividend paying method?
CRA is very concerned about dividend sprinkling with family members. And they brought in some rules a couple of years ago called the Tax on Split Income Rules, or TOSI. And those rules are going to limit how much sprinkling you can do with non-active family members. So there's definitely some hard rules there. Dividends are actually paid after corporate taxes are contributed. So they come out of retained earnings. And so what's really important is that we have a healthy enterprise, that the integration of the personal and corporate tax systems work well. And of course, later when the business is sold, that there's actually equity in that business. So there's longevity there. Canadian-controlled private corporations, when the shareholdings are held for the proper amount of time, they qualify for a capital gains exemption. And that can bring some tax-free gains to the shareholders, which can include family members. And that can be a very lucrative exit to your business. But you have to follow the rules along the way and met CRA's audit requirements. So definitely there's more compliance, more need for a tax professional to help you.
Okay. Yeah, Evelyn, exit strategy is so important because you have to think about that and how you're going to fund, again, a 20, 25-year retirement. We're so glad to have you on the show today. Thank you so much for your insights. So we'll have to have you back. Evelyn Jacks, President and CEO of the Knowledge Bureau. Well, that wraps up this edition of Strictly Money. I know taxes can feel overwhelming for many people, but let me give you this piece of advice. If you just spend a little bit of time learning about it and even leveraging a professional to help you with it, you will be much more wealthier. It's an important piece of the financial planning puzzle, and especially when it comes to decumulation in your retirement years. Well, that's it for this show. Thanks for watching.